Good evening, everyone. So in this video, we are going to discuss ARCH and GARCH models. ARCH and GARCH stand for autoregressive conditional heteroskedastic, and GARCH stand for generalized autoregressive conditional heteroskedastic models. Now, ARCH and GARCH models are basically kind of generalization of what are you going to do in the case of linear regression analysis when the variances are not constant. But even though we say that it's a generalization, the approach is slightly different here because of there are certain probabilistic problems that we are going to face. So I'll come to that in the due course. So before that, let's try to understand what is this all about, the conditional heteroskedasticity. Now, what we have done so far in the main modeling or in the Box-Jenkins-Arima approach is basically try to model the series, or I would say we are modeling the conditional mean as such. For example, if your process is RT and if you propose a model like RT equal to mu2 plus epsilon t, you are trying to model this. What could be the mu t? Mu t equal to expected value of RT given Ft minus 1. What kind of format it has got? And this is what we were trying to model. When I say we are trying to model, it could be AR, MA, ARMA, ARIMA, etc. All the models are something like this. Now, by the way, I've changed my notation slightly here. Instead of XT, we are now using RT. This is just because most of the discussion is concerning the financial time series, because this concept is mainly applicable in financial context, even though we can apply in the other contexts as well. Now, this is the usual setup that what we have. For example, if this is like, alpha plus beta RT minus 1, you have a AR1 model. Or simply beta RT minus phi RT minus 1. This is like AR1. So similarly, you can think of AR1, ARMA, PQ, etc. This is what we have been doing, basically modeling the mean. Now there is a concept, what we have learned in our entire so far discussion in the time series. We said that we can model only the stationary series, and we have some methodology to examine the stationarity, basically looking at the ACF, PACF. That's from the graphical point of view, or there are some statistical tests which we have not discussed. We will discuss them in another couple of lectures. So these are called unit root testing, or these are basically called augmented Dickey-Fuller test, Phillips-Perron test, Katowski, Perron, Smith, and Shin test, KPSS test. So there are different types of tests which can be used for the same purpose for testing the stationarity. Now, one of the other issue in this is the order selection. And the order selection, we have seen that ACF and PACF is going to help you to determine the order selection. And the model as such, what is the distribution of epsilon t? And this is also the order selection, including the model, is completely decided based on the criteria such as AIC and BIC. Then we have seen that once you fix a model, of course this AIC BAC comes later, you fix a model and then you do the estimation. We have seen different types of estimation, method of moments, least square, conditional least square, and the maximum likelihood. Then once you have the parameters as estimated, we can actually get the residuals, which is sort of representing the white noise that we have assumed in the model. And the conditions that we have assumed for the white noise should be satisfied. So we have a residual analysis where we basically try to see whether it's really a white noise. So for that we plot the ACF, PACS of ZT. We also plot, whether they are mean zero, their normality is satisfied, etc. So these are some of the things, the QQ plot, normality test. And if everything is fine, we go for the forecasting, and the forecasting is generally done by a recursive method. That also we have learned. Now, we are trying to address an issue where, this particular expression, where this is like a sigma square, is now not true. Of course, in regression you simply say it is sigma t square, but here we have a problem. The problem is, if you assume simply a sigma t square there, then this RT will become a non-stationary process because the variance is depending on the time, right? So we can't directly use that. So that is where actually the problem started. So this problem was addressed by initially by Robert Engel, and then by his student, Tim Berners-Lee. Of course, there is another gentleman also part of the whole investigations. So the Angel Granger, this is Clive Granger, this is Robert Angel, and Tim Berners-Lee. Let's look at what they are doing. So in today's lecture, we don't get into any of the model writing. We'll simply show you a couple of graphs and then try to show this explain this property of conditional heteroskedasticity. Now, what Robert Engel was trying, he was basically looking at assess the validity of a conjecture by Milton Friedman. Milton Friedman is a well-known economist, Nobel laureate winner. Uh, he says that the unpredictability of the inflation was primarily the cause of business cycles. So Robert Engel was trying to see whether this is true with respect to the UK data. And he hypothesized that the level of inflation was not a problem, but it was uncertainty about the future costs and prices that would prevent entrepreneurs from investing and leading to a recession. So this could be a possible of if the uncertainty were changing over time. This could be the only plausible if the uncertainty were changing over time. Now, uncertainty changing over time is mean that there is a lot of variation. So the Angel tried to propose a model for this whole phenomena, and what he was trying to look at, he was looking at the weighted averages of past squares of errors. Now when you have an error which means zero, then the residual is sort of representing that, and the variance, if it when the mean is zero, its square naturally will be a candidate for its variance, right? So he was trying to look at the weighted averages of the squares of forecast errors and then try to see that whether they are changing across the time, so that he could sort of say against or in favor of Milton Friedman's conjecture. But somehow, what has happened that these weights are expected to give more influence on the recent information and less in the distant past. Thus, the model was a simple generalization of sample variance. Now, while studying the UK data, there was plenty of evidence of uncertainty in the inflation forecast, which was basically varying over time. However, it did not corresponding to the UK business cycle as conjectured by Milton Friedman. So naturally, the reason has to be found out, and that's where Robert Engel stuck, saying that this is because your variances are changing across time, and we need to have the model for that. But simply, if you change the variance across time, then you cannot have any stationary model and we don't know how to handle non-stationary models. So we have to have a stationary model. So then he decided that instead of looking at the marginal variances, we should look at the conditional variances. So the marginal variances has to be sort of stationary, or it should not change over time, whereas the conditional variances should change over time as t changes. So the conditional variances should be sigma t square. Marginal variances should be something like sigma square itself. So this is what the idea, and what model can give rise to this. And that's where the Angel started his investigation and came up with the model, what is called as autoregressive conditional heteroscedastic model. So this has a lot of use. I mean, this particular model trade-off between risk and return in an important part of macroeconomic activity. Even though this is started with finance, it has been used in various other contexts as well. So I'll just give you a couple of pictures now before we winding up this motivation. So this is a data basically from Nasdaq. Nasdaq is like our BSE index. Nasdaq is uh, National Association of Security Dealers Automatic Quotations. This is from US and Canada, and it's an index of about 100 largest 103 securities issued of, so if you see this data from 2007 to 2011, so you can see that 2007 January to December 30th 2011, you see that this is basically not the prices, but these are basically the returns from the data. Returns is log pt upon pt minus 1 that we have already learned in our first couple of lectures. So you have this return, you see that this return, naturally we expect the return to be concentrating around zero because expected value of this is zero. I mean, like, of course, if there is a mean, then naturally that has to be modeled into that. So this sort of represent, as I said, represent, sorry, this kind of a thing. This is my return, and if this is zero, you are basically, because this has mean zero, so I'm expecting around this. If I don't have that, if I have constant return, that mu t will be a constant over here, and that has to be incorporated. So you can see that return log pt upon pt minus 1 is in stocks you cannot have constant return because it changes up and down. So you can have negative return because today you bought shares for 100 rupees, tomorrow it is 98 rupees, it has become negative return. Tomorrow it has become 102, then it is positive return. So it moves around zero. So, but you can see that the variation is substantially large in here and somewhere here and here. So we need to see that why this could be. What is the reason that this has happened? Now, during this, we have considered several different indices. Now, this is not just one stock, it's a collection of about 103 securities. It's an index. So, similarly, this is another index, is Standard and Poor Index, which is from the 500 large companies. This is again the NYSE, New York Stock Exchange, 500 large companies listed in stock exchanges of the United States, various stock exchanges. And these are basically, about, as I told you, that as name suggests, it's about 100 performance of 500 large companies. And you see that the same thing happens for this also around the period 2008. And if you have actually gone through the financial developments, you can see that during 2008, what has happened that there's a big crash in the financial system due to Lehman Brothers, due to the crash of the banks. So that's what happened in this particular period. And this period, of course, it is like the European crisis has happened, exit. This is for the S&P index. This is for the FTSE, which is Financial Times Stock. This is from the LSE, London Stock Exchange. Similar kind of observation that you can see. And this is from Nikkei 225. It's a company of, 225 index of corresponding to 225 companies together. And you can see that similar kind of phenomena happened for Nikkei, which is from Tokyo Stock Exchange. And this is from Hang Seng Index. Hang Seng Index is from, again, Hong Kong Stock Exchange, which is about 50 companies. And Hang Seng daily closing price, the returns, these are basically returns, not the prices, but log PT upon PT minus 1, where PT is the price on day T. So RT is log PT upon PT minus 1. Now, if you look at this, you can see that this is what called the volatility, in the sense that there are a lot of changes, there's a lot of variation that happens. Now, if you look at this, so this is what I was talking about. This is basically the prices, S&P 500, and this is the return. So returns, of course, concentrate around zero. This is a bad way of representing this thing, but it is on this axis. Scales are different. And this is the price. So you can see that this is from a longer period, from 63 to 2003, about 40 years. So you can see, and if you split this data, into 2 up to 85, and from 85 onwards the picture looked like this. So this is up to 85, and the next one look from 85 onwards. Then you may ask, why did you do that? Well, there is some reason for that. You can see that the variations are happening here, and then you can also have, this is from 88 to 2000. At these places you can have variations. uh, so this is what basically the financial volatility, or the volatility is basically the variation. But here the problem that what we have is, so if you, some of the observations from the S&P 500 plots, these observations are from the latest these plots. So you can see that the return series is centered around zero throughout the sample period, even though the prices are sometimes increasing. Most dramatic event is the crash of October 87. So you see that October 87, it's somewhere here. That's why it is split into two. You have the crash, which drove all other returns in the size of the decline and subsequent partial recovery. The amplitude of the returns is changing. See, for example, you can see that it is changing. Here it is a lot of variation, whereas here it is less variation, etc. Uh, the magnitude of the changes is sometimes large and sometimes small. It is clear that the volatility is higher when the prices are falling. This tends to be higher in bear markets and lower in bull markets. So bear market means actually the prices come down, then there's a lot of variation happen because people get panic, and there's a lot of hurry buying, hurry selling, etc. will happen. Whereas in bull market, the variation will be slightly less, because anyway people wait for price to increase further. So nobody want to have hurry selling and things like that. So generally the prior markets will be that volatile when it is a bull phenomena. So this means that there is some kind of an asymmetric volatility effect happens. Now, these are generally, there are some terminology. These are called stylized facts of financial returns. What are the stylized facts? That we can't predict the unpredictability of the return. Then, if you try to plot the distribution, you can see the fat tails. The fat tail happen because you have very large losses, and you can have very large gains as well. Of course, mostly very large losses. Volatility clustering, like clustering volatility in the sense that if at a point of time, if the variation happens, the variation continue to be there for a couple of time points, and this is what called clustering of volatility. So, for example, you might have seen that this time, if you have the habit of reading the financial newspapers, you can see that the market is volatile, which essentially mean that still the prices are going up and down drastically. So mean reversion of stability. The mean reversion is basically coming back to wherever. Generally, don't get confused. The exact numbers are not here because we are talking about random variable. So in terms of expectation, so the expectation has to be zero. So it should be sort of the returns move around the zero. Has to be zero in the sense when you have a constant return, it need not be. I'm talking about a situation where the return is zero. Okay. So you have asymmetry co-movements in volatility, and then sometimes long memory can happen. Like what happened long time back, it still remains. So in such kind of data, if you look at some of the phenomena that you can see, for example, this has mean around zero, full data and since 1990. The standard deviation is like this. This is somewhat constant, 1.00940.0104. But if you look at, the skewness and kurtosis, you can see that this kurtosis is very high in this case. So, there are a lot of skewness is minus 1.44, and kurtosis is 41 here and 6 here. So this indicate that you have fat tails, I mean leptokurtic, this kind of, the data where the kurtosis is very high. Uh, Now, what can happen in such a case? The returns and square return. If you look at returns, the ACF of that, uh, you can see them. The ACFs are sort of, lying between zero point 0.5 and minus zero point 0.5, these yellow lines. But if you look at its squares, the ACF of the squares, now squares represent the variation. So the squares represent the variance. So you can see that the ACFs are actually running through the time, or the variance is running through the time. So they are, highly significant correlations among the variations, which means this phenomena is called the volatility or the conditional heteroskedastic. So we are trying to model the conditional variance, not marginal variance, the conditional variance for the usual time series, and then what are the different types of model, and that leads to what is called the arch model. Now, financial volatility, because initially this whole idea was developed with financial, uh, popularized with financial data, even though developed with inflation data. But subsequently nowadays people started applying these various different applications where they suspect the variation, lot of variation in the data in short period of time. That's about it. Thank you.